And then we start. Perfect. So let's get started. Thank you everyone for making the time to join us for this session. And welcome to our second session on this Knowledge Build series. The title of this session is What Makes an Investment Impactful? So today's session is going to be about unpacking what impact really means in the context of investing. We'll go a bit beyond the typical buzzwords and explore how impact is defined, measured, and most importantly, I think, and interesting for you as investors, how to integrate impact in the investment cycle. We'll also look into a real case of a VC fund, Rubio Impact, to see how these principles are applied in the real world in practice. No, so here's a roadmap for the session, going a bit more into detail. We'll start with a short intro to situate this session, and then we'll define what we mean by impact and how it matters and why. And then we'll go through the key criteria that make an investment impactful and how we can understand impact throughout 5 dimensions. And we'll connect these ideas with practical examples and a case study, and then we can have an open discussion. No? The idea, as in the first session, is to make this session interactive. So please feel free to jump in at any point. Just for a little bit of context, we already had our first knowledge impact build around ESG impact and sustainability. Today we're having our second session, and in January we'll be having our third session, which is around ESG in practice. Good. So as I was already saying, the goal of the session is to provide a clear understanding of what makes an investment impactful, illustrate how the impact understood into social and environmental impact comes into play, and also to deep dive into a real case study. Please, questions, reflections are super encouraged. I will also try to throw some questions to try to have a bit of discussion and conversation, but don't be afraid of interrupting me. Great, so let's jump into this. I think we went quickly through this in our first session, no? So I don't want to spend too much time on this, but I think it's important to do a quick recap, no? So impact is about change, a change in outcomes for people or the planet caused by a particular activity. It's important to note here that impact can be intended, unintended, positive and negative as well. No, I think a general understanding when we talk about something being impactful, it's that it's a bit like an NGO type of thing of positive impact. But in reality, if we're really strict about what we mean, impact, it's here the delta, no, is the change. In terms of what is impact investing, we're referring to investments that are made with the explicit intention of generating a positive outcome, no, with financial returns. This is important. Intentionality, positive, and returns as well. And something that it's key to impact investing, it's measurement and management of impact, no? We have this saying that we all know by now that it's you can manage what you don't measure. So impact measurement and management is essential to impact investing, as it ensures that investors do not only track financial results, but also social and environmental returns. It's also about understanding our contribution as investors, and it also ties directly to accountability. No, it's important because we also see many examples. No, when people say, okay, this investment it's impactful because I'm supporting renewable energy. Let's talk about a concrete example. But where are the figures? No, how do we know if this impact is actually being positive, negative? How does it relate to the financial performance? And also to jump a bit more into the detail, I think when we talk about the impact, we can distinguish 3 levels when it comes to investing. No, company impact, which refers to what the business itself is generating. For example, reducing CO2 emissions or improving access to education. Then fund impact, that it's how the fund's portfolio collectively move the needle, generate impact. And this is done through several companies, no? And we also look at impact at a portfolio level. And then investor impact, no? That it's what us as investors can enable through capital, no? So just to say that these terms are many times a bit confusing, no? And in reports, we sometimes see these different terms not being used correctly, no? But for example, if we think of a case such as Rancilio Cube, no, we would have the investor impact, the portfolio impact of the funds that we invest on, and then the company's impact, no? If there are any questions, please feel free to jump in, no? But again, so understanding impact investing, the three different levels of impact: investor impact, fund impact, and company impact. And then speaking a bit broadly, we can think of impact into two broad types: social and environmental, no? I think this is quite straightforward and very well known to everyone in the room. But I've tried also to come into concrete examples, no, of key sectors that we're also seeing as the hottest sectors in terms of impact investing, in terms of environmental and social impact. So in environmental side, we have renewable energy, which one of the main impacts that we're measuring is CO2 emissions. Then we have also circular economy, which is very relevant. And some of the metrics that we're looking at, it's reduction of waste and increase of resource efficiency. And also a very hot topic at the moment is sustainable agriculture and regenerative farming, no? This is very connected to biodiversity, soil, and water conservation. In terms of the social side, we see a lot of traction on financial inclusion, mostly on microfinance platform, and some of the metrics related to that are around the increase of access to credit for underserved communities, healthcare access. Here we're seeing a lot of telemedicine solutions, and education technology, mostly edtechs. We're seeing a lot of traction there. And here I wanted to start with the first icebreaker or question, no? Taking into account the terms, no, the concepts that we have just been looking at. In your view, what do you think it's harder to measure or to account for, social or environmental impact? Do you have any thoughts or ideas on this?
Not so many. The only thing that I actually read the slides before the session, so I know the content a bit more than the rest of the pack. But the only thing that comes to my mind is that this impact definition is identical or very close to the one of economic externalities, positive, negative, which is something that, I mean, they're usually defined as the byproduct of any sort of economic activities. In here, we're saying, let's recognize that there is something outside of the pure economic result, and we can influence, or let's say we can act as us as investors, but also the company, to make sure to maximize also other variables outside of the traditional, the traditional ones. I don't know if it was clear enough.
No, totally. And I think you made a really good point, Lorenzo. Thank you for bringing it up. I think it's very similar to conducting an impact materiality, you know, and also part of building an impact measurement and management system. A big chunk of it is doing a financial and impact materiality, no, where you look into the externalities. A bit the differentiation is when we do a materiality assessment, is to, as you very well said, to look at the implications of our activities beyond the financial terms, and trying to understand the positive, negative, intended or unintended results as a risk management tool, no? The idea of impact investing, it's a bit broader, no? And we're going to be seeing it a bit more in the next slides on how we see how to handle this in the whole investment cycle, no? Not only ones that it's normally when you do an impact materiality, but how to integrate these thoughts, this approach into every asset class, into every investments, and into the regular investment cycle. Good. And I can share a thought in terms of the measurability on the question that I was posing, but also feel free to jump in or comment. A bit what I'm saying is that we're reaching a bit more of a standard on the environmental side of impact. So we're seeing many funds and investors that are monetizing CO2 emissions. No, we're seeing carbon credits, and we have a bit of a standard, no, that everyone is looking at CO2 emissions. While on the social impact sectors, it's a bit harder, no, to come to an agreement or to have standard metrics that can be comparable across different portfolios. So that's a bit my key takeaway, no, on this. I don't know if you've seen also this in your day-to-day, no, that many funds report on CO2 emissions or start to talk about this, but not so much on the social side.
Yeah, I mean, from my side, what I've seen is that, of course, there is the CO2 emission because you can trade them, so it's easier to make a numbers. Social impact, it's always difficult to assess. How does it mean to improve the health? I mean, it's something that is difficult to be measured.
Totally. Good. Okay, so we already went through this question, and I wanted also to bring here a concrete example of social and environmental impact. This is actually one investment in the iGravity portfolio, which is Term Impact. So this is a company that works across sub-Saharan Africa, where over 600 million people lack reliable electricity, no? So they support companies that are tackling these challenges through providing clean energy in different ways, and they help them scale across the continent. And here it would have a bit of the mix, although at first glance it can look that it's mostly an environmental impact type of investment. It also has a strong social impact angle to this. Why? Because having access to energy has direct implications on, for example, access to education, access to healthcare facilities, no? So for example, if we look at the concrete example of Haven Hill Synergy, which is a company in Nigeria that Term has invested on, through the installation of solar mini grids, they have electrified more than 60 healthcare facilities, improving access or providing access to more than 700,000 patients annually, no? So of course, the most evident metric is on the CO2 reduction, but it also has a big implication on the social side, no? As they're providing access to electricity in rural and marginalized areas. Good. Yeah, if any thoughts or questions on this, is just a bit to illustrate a type of example of an investment that can look very straightforwardly environmental, but also has a lot of social impact implications, no?
And you said, sorry.
Yeah, go ahead.
No, but you clearly said it, Belen. So this is very straightforward, right? So electrifying communities that are off-grid, of course, means that there are so many positive externalities that comes with that. I think it's way more difficult to try to understand an impact of an investment or an economic activity in other contexts, right? So the same company selling off-grid panels in Europe might have still a positive impact, but I wouldn't say impossible to measure, but that can be measured in a very, very difficult way. I don't know if you see my point.
No, totally. I totally see your point. And let me get back to your comment in a few slides, no?
Okay.
Because now we're going to be looking at the key criteria of impact and looking at the different dimensions we can assess, no? Whether an investment is more impactful or than other in terms of different aspects, no? Is it more impactful to invest in Africa than in Europe? And a bit on that. So let me get back to your question in a few minutes. Good. So key criteria for impact. As we were just saying, impact can be a really buzzword. So we have three main criteria, 4-ish, that define this, no? So as I was saying at the beginning, and I'm repeating a bit myself, but I think this is very key, it has to be intentional, no? An investment that is done in certain sector and it has positive externalities just because of the business, but it was not thought as impactful or with with the intentionality of measuring it, generating positive impact, is not considered an impact investment. Also, we look at contribution and additionality. That is the degree of, in our case, the investors, we're contributing to generate this positive and social environment, no? And here, I want to stop for a second on contribution and additionality because it links really well to your point, Lorenzo, no? So we understand contribution as the support. I'm talking now because we have the three levels, no, of impact that I was explaining before. I'm talking about the investor perspective that I think is the most relevant in this case. We're looking at contribution from the eyes of the investor as what goes beyond the financial support, no, the fundings we're providing as part of the investment, and that is, are we helping them scaling their activities by supporting our advice? Are we providing technical assistance? Are we also helping them raise additional funds by connecting them with peer investors? This is contribution to the investment. And then we have additionality, which is a bit thinking about the counterfact. What would have happened if I had not invested in this company or this fund, no? So if we compare a bit an investment done in Africa versus in Europe in the renewable energy space, this additionality concept would be very relevant. Why? Because in Europe, the investment market is much more mature. There's much more capital and ways of fundraising for companies, while in Africa, we can think that the capital, it's more catalytic, no? So there's one way of differentiating. We can also look at this example when we jump now into the 5 dimensions of impact, but this is a way to look at this, no? Conditionality. So the investor's capital would create outcomes that wouldn't happen otherwise if we would have not invested. And then the third criteria, and I'm being very repetitive on this, apologies, but I think it's the definition, no? I think it's important that it's clear for everyone, is measurability, no? We cannot claim that an investment is impactful without having figures that speak to it.
I have issues in understanding the intentionality point.
Mm-hmm.
Meaning, I understand that, I mean, if I
Yeah.
want to label myself as an impact investor, then I need to have the intentionality to do so. But the intentionality per se doesn't change at all the positive outcome of an investment in terms of impact on social or in the environment.
I would disagree on this one, Lorenzo.
Okay.
Why? Because if there's intentionality, it means that impact should be integrated into the investment cycle. So I think that's a really good question. How do we look at intentionality? No? So for example, if we're doing an impact screening and then an impact due diligence as impact investors, it's really important for us to look at this to avoid impact washing, sustainability washing, and so on. Because one can claim that it's an impact fund or that they're generating a lot of impact because, for example, they're investing, let's say, in Africa, no? That it's, I think, the typical example. What would we look into as part of our screening and due diligence process? We would look into the investment strategy to see if this is reflected. We would look for such documents as policies, mission, vision, and we would also look if there's a structure to how to integrate impact into their investment cycle, whether there's a budget, for example, for measurement of impact, and whether there's FTEs allocated to this, no? Whether there's an ESG officer or an impact officer as part of the fund structure, no? So intentionality should be permeating the whole structure of the vehicle, in this case, the fund or the manager. So it should affect, no, the overall impact, because one thing is just saying, okay, I'm impactful, but if there's an intention to it, it should be reflected throughout your structure and portfolio and processes.
I see your point, totally.
Okay. Great. So to further understand the impact of an investment, it's important to look into the 5 dimensions of impact, which we will see in a second. But I just wanted to very briefly talk about one of the main standards in impact investing, which is the Impact Management Project, which helped create a global standard for understanding and assessing impact across 5 dimensions. These dimensions are what, who, how much, contribution, and risk. This framework, it's relevant because it helps investors evaluate the outcomes, the expected impact that they're wanting to generate, and their own role in enabling this change, no? It's also important because it supports comparability, no? So as to take the example that Lorenzo brought to the table, no? A fund in Europe investing in renewable energy and a fund investing in the same in Africa and Europe, it would allow these 2 funds to speak the same language. It's my sorry. So yeah, sorry, because my slide went for a second. So it would allow the 2 funds to speak the same language when describing the impact. So it would allow us to compare, no? And to account of, are we generating more impact with Fund A that's investing in renewable energy in Europe, or with Fund B investing on the same in Africa? We'll see. And then lastly, according to this standard, impact investors can use a range of strategies to contribute to impact, no? And they claim that the role as impact investors could be to signal that measurable impact matters, to engage actively with their portfolio investments, to grow new or undersupply capital markets, and to provide flexible capital, no? So to look a bit into these 5 dimensions, what do we mean? So the first dimension is the what. It's what impact are we expecting? Then who are the beneficiaries, or the people, or the planet? It can be on the planet and people side are experiencing the change, and how underserved they are, no? Here, going back to our example, this would be one of the criteria that we could compare, no, across our Fund A example and Fund B example, to claim whether an investment is more impactful than other. Then how much of the change is occurring? And here we normally look at the scale. Is it something that it's at a micro level around a few marginalized communities, or is it something that it's happening at a regional level, no? Here it would also be very interesting to look at Fund A and Fund B, no? Maybe Fund A on this dimension is generating more impact because they're being able to have a much larger scale because of the grid structure in Europe than Fund B, that it's only targeting few marginalized communities. Then we would have contribution and additionality, that would this change likely have happened anyway, and also trying to understand our contribution as investors. Are we bringing more than finance to this investment, or only the financial contribution? And then the impact risk, no? And here, if you're interested, these risks are typified. We have 7 types of impact risk, no, that go alongside assessing the risk to the change not being positive, the risk to the planet, and the risk to the people. So this is a bit the holy grail, so to say, in impact investing, for comparing whether an investment opportunity is more impactful than other, and also for assessing an investor's portfolio. And to give a very practical example, no, how we see that investors apply this and how we apply it at iGravity is normally this is translated into a scorecard that is conducted at the due diligence stage to assess the different dimensions and have an overall score and compare it with the portfolio. Any questions on this?
No, for me, it's super clear.
Good. So now let's connect a bit this theory into the practice, and let's look at the integration of impact in the traditional investment process. No, so here you will see that on the top I've described a bit the traditional process. No, I know this can vary a bit, no, or people sometimes split some of these steps, but to have a general overview. And we also see what are the impact goals and the main impact activities that go alongside the traditional investment process, no? So we start with the screening and appraisal. We would focus here on identifying opportunities that align well with impact goals. And if we're also applying an ESG risk management perspective, we would also look into this, no? And as part of this, we would really need to look into understanding the macro context and the problems that the fund or the company is aiming to address, no? So to go back to example of investing in renewable energy, what is the main problem that we're addressing? Is it that the fund is aiming to provide access to communities that do not have access overall because they're off grid? Is it because we want to help them scale renewable energy and to reduce costs for the end beneficiary? And part of the screening and initial appraisal should also look into understanding whether the strategy that they're proposing makes sense from a financial and impact point of view. If this goes well, we would go into the due diligence phase, no, where we normally look into financial and impact potential, understanding risk, stakeholders, and outcomes, no. And as part of the due diligence, an impact investor would focus on establishing key impact indicators with targets. So really trying to say, how are we going to assess the performance of this investment alongside IRR, so to say, no? What are the key metrics going to be for us for assessing not only the financial returns, but also the social and impact returns, and to make a recommendation, no? And then we would, if the recommendation is positive and the IC goes forward with this, we would go into signing and closing. That it's here we would look into making impact a legal requirement, no? So having part of the term sheet that, for example, the fund needs to report to us on the key metrics that have been decided to assess the impact performance. And then we would move into the portfolio management phase, no? Here would be the reporting and also to support the investees on impact strategy and measurement. And lastly, and this is something that it's currently being very discussed in the impact investing sphere, it's about responsible exits, no? So to plan ahead and to have an approach to making exits, no? How are we going to ensure as impact investors that once we exit a fund, the next investors or the buyout keeps also this impact intentionality, no? Yeah, so the goal of integrating impact in the investment process is to make it in a structured way and to make it in a systemic way, no, ensuring that the financial and the impact processes go hand to hand in a holistic way and not something separate or a plugin that you do as a one-off. Any thoughts or questions on this?
In your experience, is it difficult to, let's say that you find a project, a startup, a company that really has the potential to have a very large positive impact, right? But the measuring part of the game is not at all on their radar. So they're not even keen in measuring anything. So is it difficult for an impact investor to go in and, let's say, oh, I don't want to use the term educate, but let's say teach the operating team how to properly measure things, and most importantly, to have them understand what is the value of measuring such an impact?
It is indeed a challenge, no? Especially when you find a good opportunity that is also aligned in terms of financial returns and has a really good impact potential, right? So what we try to do in these cases is to go really deep into this topic at the due diligence stage and try to understand whether they're open to start measuring it, no? And as you said, part of this, it's a lot of around awareness in terms of why it is important to measure these things, no? For example, we also try to think, it's also for us a way of identifying red flags and potential impact washing, no? Because if a fund claims to be generating a positive impact, or if a company is aiming to generate positive impact, this should be baked into their business model, right? If I'm a company that I'm claiming that I'm providing access to education for low-income kids, then if I'm not measuring this, and this metric is not a key KPI in my business model, no, and something, an information that is strategic to pivot, to make decisions, it's also a signal that there could be a bit of impact washing, no? That's one option. And the other option is that they're very early in the game and that they don't understand the benefits of starting to measure these KPIs, no? In those cases, normally after discussing with them, they're opening to start measuring one or two metrics and commit to start their journey in measuring, no, with our support, no? And we also try to convey a lot the message of the importance of on the benefits of measuring, no? For me, in my perspective, what I always try to communicate is, one, making more informed decisions, especially if you're claiming that impact is embedded into your business model. And second, there's also a benefit of fundraising, right? How are you going to be approaching other impact investors, and how you can raise additional capital in your next round, no? Reaching out this crowd of impact investors is really key to show your impact results.
Grazie.
But it's indeed a challenge, no? Good. So I wanted to come up with an example where you could relate a bit to, no? So I came up with this VC fund that it's Rubio Impact Ventures. They're based in the Netherlands, and they invest in mission-driven early startups across three main impact themes: inclusion, circular solutions, and healthy living. I think, and now we're going to see in a second a bit of an example of some of the portfolio companies, what makes them apart, or going back to the title of this session, no? What makes them impactful? What makes their investment strategy impactful? I think it's really important, their intentionality, their contribution, and measurability, intentionality, additionality, and contribution, no? If we look at intentionality, impact objectives are very defined upfront. I think if one goes into their website or speaks about them, we can see how impact is embedded throughout the different the different phases of their vehicle. I think, and I have not included this here in this slide, but also something very relevant and what Rubio are pioneers of is that the team carries also linked to impact results and to impact targets. So I think as impact investors for us, this is also a really good signal of their intentionality. Also around measurability, they align with the best standards in the market, which are IRIS Plus and the SDGs. And they measure progress and apply an impact scorecard throughout the screening and due diligence and also portfolio management. And every portfolio company must demonstrate measurable contribution to social and environmental challenge. Here, I want to pause for a second, because as you might know, and as I have also been discussing with Lorenzo and Massimo separately, when you're working with a VC fund, the investments are made so early that the challenge that you were just mentioning, Lorenzo, no, around measurability, it's really difficult, no? We will see in a second, because many times they're super early startups that are working with a concept and that they don't have yet many results. So it's interesting also to see their approach and how they blend qualitative and quantitative information. And also in terms of additionality, I think it is worth mentioning that the team applies both a contribution and additionality approach by being very close with the portfolio companies and supporting them with expertise and also helping them accelerate their solutions. A question here?
Yes, Belen, just a curiosity.
Mm-hmm.
Is a VC impact fund by definition a generalistic fund? I mean, in your experience, do they invest in specific segment or in different sector? Because take an example, this one, Rubio. The focus area are inclusion, so education, financial service, and healthcare. Then circular solution, that is something relating to waste energy, that is something that is not really addressed in the first goal. And then you have the third one that is generally speaking the well-being. That could be everything. I mean, in your experience, is it something really diversified or focused?
I think it's quite diversified, to be honest. I think if we look at as what you were just saying, no, I think the focus areas are quite broad, right? So we have inclusion, circular solutions, and healthy living. So I think it's a bit of approach of saying what we're not investing on, then rather than what we're investing on. I don't know if this makes sense. But more of saying which sectors they're not going to be investing on, and then keeping it broad, a bit generalistic with 3 focus areas, no, to be prioritized. But for example, let's look a bit into portfolio sample, no. So what type of companies they have and how they relate to the impact themes. And here, all these companies are based in Europe. The fund is only investing in Europe. So they have SimPower, which is clean energy and climate. SAMA, which is inclusion and employment, so around a platform for dignified digital jobs and training for women and youth. Vital, which is around packaging, so reusable packaging for food delivery and takeaway. And then, for example, we have a company which is called Female Invest. It's a platform for financial and investment training for women. So coming back to your question, Massimo, I think a bit generalistic, but prioritizing the 3 impact themes that they're outlining. Does it respond a bit to your question?
Yes, it does. It does. So the investment thesis is centered around the ESG purpose and not the real industry.
Around the impact purpose, right? If we recall well, ESG, it's mostly around the risk management, which they also integrate. And then they have a bit broader the change that they're generating inside the company and outside the company, you know. And then looking a bit about the KPIs and the early stage of the companies. And we will see a bit in the next slide. and when we were talking about the investor impact, the fund impact, and the company impact, no? So as we were seeing the portfolio, it's quite diverse, and every company is very early stage. So for example, this one is measuring tons of CO2 emission, then formal jobs, number of containers recycled, paying members of a platform. So there's a big challenge in the VC space of then aggregating at the portfolio level. Okay, and this is something that I think, for example, in the case of Rubio, they really explain it in their impact reports, no? How they're trying to also aggregate at a portfolio level, but also acknowledging the challenges of working in the VC space with such early companies that every of them is in their own sector doing their own thing, no? And being a bit generalistic. But I think what is relevant here is that for each company, they have KPIs. For each company in the due diligence process, they establish clear impact KPIs and they establish targets. And if we go a bit into the 2024 results at the portfolio level, what is a VC fund reporting on, no? Because they report in each of their companies, but then they also need to say something on the fund level, no? So they have generated over 3,000 jobs. They also report on diversity. They also report on the new investments done and the responsible exits. And I here also wanted to include a bit of a snapshot or how themselves they talk about their impact methodology, no? And here you will see how we find the 5 dimensions of impact integrated in a different layout, no? So how everything starts in the investment process is looking at the problem, the what, the who, the how much, the additionality, and also something that they've incorporated lately. This is something that we're going to be discussing later on in our curriculum, as we have one session on the main trends that are currently happening in impact investing, innovative financing, and so on, which is systemic investing or systemic impact. Good. So I want to be mindful of time because I know we're a bit behind. So let me try to wrap up quickly. I don't know if anyone needs to leave or if you have any questions, but I think here something that I want to highlight and that I've been trying to convey and to transmit throughout this session is that impact can be thought as the 3rd dimension of an investment, no? So we have, and this is how we think as impact investors, no? Our 3 main dimensions are risk, return, and impact. And a little recap, so impact is the change in the real world that it's caused by your activities, by your investments, no? Good. Any questions here?
Super clear.
Oops, sorry. Then going back to a bit the recap and the key ideas that I want to transmit and to convey here is that impact investing is not an asset class, but it's an approach. We can debate a bit whether it's new, not new, but it's certainly a word, no, or a term that we did not hear 10 years ago, no? But this approach can be applied throughout different asset classes, no? So we can apply it to fixed income. For example, we do at iGravity, private equity, debt, credits, real assets, and then bringing it all together. So impact is not just about doing good, it's about causing change that it's positive and measurable in the real world. So we were speaking on our first session about risk management and ESG. It's going a bit beyond that. Impact has to be intentional, measurable, and additional, no? And speaking a bit broadly, we can differentiate between social and environmental examples, but in reality, we see them that they're quite interlinked as well. So I wanted to close a bit with this wrap up, transferring a bit the key ideas of this session, and also wanted to leave a bit of space for any questions or thoughts.
I totally see your point. about impact being an approach and not an asset class. I think there are sectors or industries where it's way easier to apply this approach than to others.
Agree.
And in a way, connecting it back to Massimo's question of before, I'm sure that there are some natural industries where there is more impact activities than in other sectors, right? So even the same company doing the very same, I mean, making the very same product, but in two different countries, can be seen on the one hand as an impact company, but on the other, not at all. So the same off-grid solar panel manufacturer in Nigeria it has a different sort of let's say allure of reference than this very same company in Germany, for instance. I don't know if you see my
Totally. No, I totally agree. And I think in order to assess whether it's impactful or not, it's key to go back again to the criteria and the 5 dimensions of impact, no? Not just to say, because it can also be the other way around, no? That maybe the company in Africa is not generating that much impact, and the company in Europe, on the other hand, which can be counterintuitive, it's generating greater impact, no? So I think also a key here is to try to be systemic, no, and structure and use the standards to assess this.
Absolutely. And the other thing that I bring home from today's session is that measurability, or actually measuring by design, so having the measurements embedded into your business model is key. I mean, if you try to actually, I think that if you try to build a measurement framework on top of a company who has not at all been designed to be impactful, it's again a failure by design. So you're trying to actually harness something that has a totally different nature.
Totally. And many times we'll think about impact measurement and management as something very costly and something very complex, no? But it can be something that it's very simple and that you start with, no? Such as defining key metrics that are core to your business model by design, no? In the inception, and then you can improve over time, no? And you can get sophisticated or monetize your impact, you know, and do much more things. But also simple is good, and starting somewhere, no?
Grazie,
Good.
Belen.
Thank you all.
Grazie.
Thanks a lot.
It was a pleasure.
Ciao.
Thank you so much.
Okay.
Have a great afternoon.
Thank you.
Thank you.
Ciao.
Bye bye.
Bye bye. Ciao, ciao.